Phil, we're back. How you been?
And first day of financial year, how you going, man?
Very good, very good. We haven't caught up for a while. I'm guessing it's because we've both just been slammed.
Flat
Very
out, man. The market is really starting to heat up. I'm sure you're feeling that too, man. People are
yeah,
really starting to
100%.
get into it.
100%. How's it been the last few weeks? That's what we're catching up about today.
Yeah,
Looking
yeah, it's good. The last month, I'm finding a lot of buyers. They're starting to kind of see that the prices are basically what they are. They're only going to go up. The options aren't getting that much more. There's definitely supply starting to creep up, but not the point at which they're thinking. And there's definitely a lot more buyers waiting on the side compared to what's actually being released. So I'm seeing properties up and under offer basically straight away, almost depending on the area,
Mm.
especially the more prestigious or the more, busy areas that people are going in for investment side of things.
Yeah.
Seeing under offers basically as soon as they get listed, even if they make listings, some of them, a lot of them off market. So we had a couple off market ones as well.
Yeah, it's crazy. I think we've gone from a state of a bit of confusion, uncertainty from Q1 or holiday period last year into start of this year, where buyers are thinking, what's actually going to happen in the market? Property prices have been growing. Have certain markets peaked? Should I be buying that location? Elections are coming, negative gearing. All these questions were kind of running through the mind. And since then, we've had a landslide victory from the election perspective. So policies are very clear. People understand what's going to happen and they
Yeah.
understand it's very bullish for property now, especially with those new first home buyer schemes we've covered. We can touch on again. They start Jan 1st, 2026. And obviously, rate cuts have begun. So, since rate cuts, that confidence, we've always been talking about consumer sentiment, confidence in the market, people rushing back in. So, I've seen live, like from the last 6 months, buyers go from uncertainty, let's just wait on the sideline, into now confidence and even getting into FOMO stage, to be completely honest with you. And you mentioned you're seeing properties wrapped up, under a few days, not going to own home opens. We're seeing that in a lot of markets today. So if you look at, the core logic, prop track indexes, the national level, capital cities are growing like 1 to 2% a month today. But again,
Yeah.
there's markets within markets. We're seeing suburbs performing at double-digit growth in these first 6 months alone this year. And I'm not joking, like I've been on the obviously phone with agents every single day. There are still markets in Melbourne, Perth, Adelaide today, Queensland, where properties aren't going to home open, or if they are going to home open, there are multiple offers ready to go. People are even going unconditional now. So it's becoming actually harder for us to secure the right deal for our clients because we have to negotiate the right protections, the right clauses. We're not just going to rush into a deal with firm, obviously. So if I'm securing something, we're going to go in with a finance clause, a building and pest clause, make sure there's no risk to the clients. But there are other buyers in today's market that are just going in unconditional offers, taking that risk on
Yep.
themselves, not even worrying about a building or pest inspection. There's so many things happening. And that's where, when you're on the ground and you get that kind of real insight from the agents, you can see live what happens before the data results come out. So when we're
Yeah.
seeing these numbers like, 2% growth in Melbourne or 5% growth in Perth or whatever it is, on the ground now, right now, there is FOMO. And that will again come into the data over the next 2, 3 months. And that's where I think you'll see more FOMO coming to the market as rate cuts continue. So properties become more affordable because the by spending, their borrowing powers will increase. And then you've got the favorable first and policies coming in Jan 1st, 2026. And that will just create a whole rush of new buyers, first-time buyers who couldn't afford a property today, but they will be able to buy property soon. So it's kind of like we've got this really strong fundamental growth period coming in. And you mentioned from a supply perspective that hasn't improved. So
Mm.
it's going to be a very crazy, in my opinion, 3 to 5 years. I think you're going to see a lot of growth,
Yeah.
especially in the right market. So, I mean, the risk is now more on people who are not able to enter the market sooner, in my opinion, just because of the fact that you do have that kind of sense that you might miss out. Are you seeing people like panic from your end? Like, are people calling you and saying,
Definitely.
"Hey, or what's happening?"
Definitely. And I think panic is the word, right? Panic and anxiety. I think those are the words, right? Of
Big.
fearing of that you said missing out. Like we got real estate agents now, as you said, no financial clauses, no pest and
Mm.
building inspections, and they have the power to actually negotiate that for their clients, right? And we just have to accept it. And then from, a finance perspective, I had a couple of clients worried about not being able to have finance clauses because, with all pre-approvals, although the bank has checked it, they might not have checked that specific property, right? And so with a lot of changes in the markets, like clients can get uncomfortable with being able to just clearly just give 60K to this person without really being able to check the property thoroughly, right? And so really, and if you don't, you've got someone there that's going to be doing it for you that might be willing to just take the risk. And if there's a problem with it, they probably have the cash to fix it. So it's become really competitive in terms of trying to actually secure the right property at the right time, right? And we're seeing more and more people actually kind of lose out on that because of that. And sometimes they might rush into things. So that's why it's really careful not to really rush into that property that you found, right? But there definitely is a sense of urgency in finding the right one because, as you said, the next 5 years, what's going to happen in the next 5 years that's going to be really changing supply, right? We're not seeing too much more getting built. We are, but not too much. I think, from the trade connections that I have, more and more builders are actually going under. More and more trades are actually really struggling to make ends meet and pay debts, right? And so now with prices going even higher, it's harder for developers to even make a profit,
Yeah.
right? So that's what makes it even worse for these people that are
Yeah.
trying to get into the market. And maybe, that's why we're seeing more people just settling for what there is at the moment, right? And as you said, right, every city is seeing this, right? Everyone was running away from Melbourne last year, but now I'm sure you can find a couple of suburbs that are at that 10% growth from last year till now, right? And a lot of it is genuine investors and genuine owner-occupied people that genuinely want to live there. So it's not as if we're getting a massive flush from overseas that people are just dumping money in because Australia is a safe asset class. It's people are actually moving here, people are actually living here. And, especially in Sydney, we're seeing rent climb to a height where density is becoming so the next best thing, right? We've had a few clients in especially the inner west of Sydney having developers come to their house to actually, develop their home and split it up because there's just not enough supply. So we just have to make more from what we have at the moment, right? And I know a bill would actually council approved 12,000 homes,
Mhm.
right? Where that's going to fit, how that's going to work, we still don't know. But at least we know with the government, being in place, we know the trajectory that we're going through. We know what areas are going to see a lot more growth from what's actually already been committed to. And then from there, that's where the areas we're seeing, really explode. Like we're seeing a lot of attention in the Newcastle region as well, because you're seeing Sydney, no matter how west you go, you're spending over $1 million and, you're just so far away from other amenities that you might, enjoy as well. That's what I'm kind of seeing the most of.
Yeah, yeah. And I think you made a really good point about when you're first talking about buyers kind of panicking and trying to get into the market, almost rushing. It's very important not to do that today. So I know the market's moving, and I understand that you want to get in, you want to make maximize the growth periods and buy a property before it grows in value. But when you're going into the market without a strategy, without an understanding of how to structure your finances or how to make sure you're protected in the purchase, that's where you'll get burnt. So
Yeah.
with our clients, we always work with your team and we're always looking at a way to strategize how to build that portfolio the right way and something that's going to suit their goals and requirements and their lifestyle. So if
Yeah.
you're not working with the right financial structures in the first place, you're not understanding your cash flow, your budgets, thoroughly and going into a property then that doesn't suit those requirements, you're going to be rushing, but you're also not going to be holding the property for a long period of time. And ultimately, you're not going to benefit out of this market anyway. So there's
Yeah.
no value in any buyer today going into the market without the knowledge and the research and the experience, and also engaging the right team. Whether that's paying for services or not, that's a different question. But understand your, financial structures, what you can do from a lending perspective first in all the
Yeah.
detail, educate yourselves, and then move into the market. That's very crucial.
Yeah.
Obviously, to your point, different markets are growing at different rates at the different market cycles. So not every market's suitable for you, but at the same time, you don't want to get burnt because the last thing you want to do is rush into a market today that people are, seeing there's a lot of growth potential. And then even though you buy a property, it's actually worse for you because you can't hold it, and then you're losing money because you can't
Yeah.
hold the property in the best time frame to do so. That's very,
Mm.
very crucial.
And potentially overpaying, right? Because you're buying
Yeah,
hype sometimes, right? And
100%.
everyone's thinking about one particular area. And if you've heard about it on the news or something really generic, Facebook, it's probably too late, right? There's a
Probably too
reason
late.
why
Yeah,
it's
yeah.
it's probably too
100%.
late. So,
Most of the
and
times,
also
it's accurate. Yeah.
Yeah, and as you said, strategize, right? So not to get overwhelmed saying, oh, Sydney costs 2 million to live here, I can't afford it. But understanding, okay, well, I can't afford it now, but what are the steps going forward to
Yeah.
actually get there, I hear an argument that some people say is, if you buy somewhere cheaper, that Sydney's just going to grow faster and you're just not going to be able to actually do it. But then you're not going to just not buy anything just because it's too hard, or you're not going to try to invest somewhere else within your budget just
Mhm.
because you want something a little bit better, right? A
Yeah.
lot of that comes when emotion comes involved, and you think, okay, well, X person did bought in this place, and that's a little bit nicer than when I want to buy. But just because they've done that, we don't know their full picture, and everyone's got their own goals, right? So that's where we balance that balance between finding a property that's really remote, that gives you good rent, but might not grow as much, or something with a bit of a balance where it is going to grow and it is covering your expenses where you don't need to put too much, right? So it really is important to actually strategize and budget, not just grabbing what's there. I know that's a broken record of something that we say all the time, not just snapping what's there, but actually plan and strategize 5 to 10 years and how is that going to look, right? And so every market, as you said, is completely different, right? A house in Melbourne for 700 is not going to give you the same rent as a house in Adelaide or in Perth for 700. They're all completely different, but they also all have their own costs, right? Like, for example, Queensland has a lot more insurance risk and a lot more natural disasters that people need to worry about. So everything is within your own specter. And another good example is trying to lean on what you already know, right? So an easy one is like trades, right? You don't have to be a builder to build a house, but if you're a painter or if you're a landscaper and you have friends within the industry, then you basically have to use them. And, to a lesser extent, if you work, a white collar job, where you're an accountant or you work in some sort of financial institution, you have to lean on that information and know what information you can draw from there. And what I mean by that is, someone from a financial perspective can look at the numbers and look, around the country what's best. Or someone within a trade industry can know, okay, well, this property is not nice, but it's nice in my eyes because I know where I can make this value. I know I can repaint it. I know I can change this X and Y, Z. And now that property is worth way more and I can actually afford this, right? So that's what's something that people don't really need to consider enough. I think from what I've seen with a lot of my clients is leaning into what you know personally and seeing if that, because that will make you feel more comfortable in your actual investment
If you're
once you
comfortable,
actually commit.
you'll maximize your results there for sure. Yeah.
100%.
Yeah.
Exactly right. Exactly right. So if you're just moving at it blindly or, outside your own comfort zone, then of course you're going to get that anxiety and that might cause you to panic and sell
Yeah.
and sign straight away instead of really thoroughly looking if this is right for you.
Yeah, yeah. And it's crazy. Like your first point, just quickly, you mentioned about price, looking at price points, looking at that as a indication of whether you should invest in the market. We made a
Yeah.
post about this a few days ago where many people are still targeting, let's say, sub 550, sub 500 price points in general. And I was looking at all the LGAs that consist of median prices under $550,000 today. And it's funny because literally all of them, which are still, diverse economies, populations over like 50,000 people, somewhere where you would mentally still be able to invest in without, having nightmares every night where I put my money, but like foundational locations where you can still invest under 550K. And most of them have already grown 50+%. Now, I'm not here saying they've peaked. I'm not here saying that they're not going to grow anymore. I'm not here saying they shouldn't be investing there at all. But there is, some kind of risk buying in a market that's grown 50% plus. So you always have to understand it's not always price point. It should
Yeah.
always be looked at from number one, does this have the right fundamentals to grow to the levels I wanted to see it grow? Are there any risks in the next few years? And does it suit my requirements? So, like, if you invest just on price point alone, you're never going to be investing in strong capital city growth
Yeah.
locations today. And that's
Yeah.
my main worry. So, any client that comes on board, we're always prioritizing capital city first.
Yeah.
If you look at historical data, capital cities always perform better. I'm not saying we don't invest in regional markets by any means, but that's always for diversification or specific budget clients or whatever it may be. But overall, we want to focus on the right growth locations to stack the probabilities. And even, for example, people in Sydney today, we're seeing a lot of clients come on board with a bias to stay in New South Wales. So they
Yeah.
might be looking at a Newcastle or a Wollongong
Yeah.
or a Kiama or whatever it may be. And recently, Albury's been pretty hot. And they're all great fundamentals in some locations, but a lot of the times they're very focused on location from a price point perspective. And once we understand the full perspective, the data, the research, they're going interstate or they're going to a
Yeah.
different location altogether. And that's where we really have to understand, don't just focus on one indicator for growth. You
Mm.
need to stack all the probabilities in your favor,
Yeah.
especially in a market like today, where even to your point, if prices are going to increase across the market nationally, if you're not outperforming, you're basically not doing as well as you think you are. So if you've got a goal to build and buy your own home in Sydney, and your
Mhm.
property has done 5% growth and that city suburb has done 10%, you've lost,
Yeah.
unfortunately. And that's
Yeah.
where it becomes so tough today because sometimes in a bull market, a raging bull market, it's even tougher because there's more pressure on you to get the right asset
Yeah.
and scale to that extent. And that's where, again, I think that next level of FOMO from the investor side will just increase in the next year or two. Because
Mhm.
now a lot of people will be chasing how to buy their own home in Sydney, to your point, or get, their ideal location in the capital city. And they're looking at all these kind of growth avenues, but they're ignoring the foundations in the first place. So it's
Yeah.
going to
Yeah.
be an insane market, man. I hope that a lot of people will do that research and don't get burnt.
Yeah. And are you asking people, or are they asking you a lot about, any rate cuts or any tariff implications on the market? And is that how much are you strategizing for that in your properties?
Yeah, that's a very good point. So, from a rate cut perspective, we were kind of predicting, we'll see a Q on rate cut and that will spark, more demand in the market. We've seen that, and we've seen historically from the first rate cut, if you move forward 2 years, the market's increased by a minimum of 10%. So we know that rate cuts have a positive impact on property pricing. So we haven't really changed our strategy from, the type of locations we're targeting, the fundamentals we're looking for, the kind of market cycles we can target for different strategies. So that's all there.
Yeah.
Now, I'll be very open and honest. There are locations we're not going to buy in regardless if the rate cuts or not. So we're not buying today in Darwin. We're not buying in Northern Territory. And largely, there's a few areas in Tasmania we're not buying in. We're trying to stick to more foundational locations to stack probabilities in our favor. Now, that might be
Mhm.
controversial. It might not. It's just working for us. It's working for our clients. But the next thing is rate cuts will keep happening. And I'm not saying they're going to go back to COVID levels, but we've always talked
Yeah.
about them going to that 3% range. So that will be bullish for prices moving forward. Now,
Mhm.
obviously, property prices are still growing while these rate cuts are happening. So yes, you get the more borrowing power, you get that additional spending ability from the consumer side, but properties are still growing. So maybe they're not becoming as affordable as we assume they're going to be. That's why we're
Mhm.
still targeting that affordable price range. And I'm not talking from
Mhm.
a price point perspective again. We're looking at affordability indexes, which show ratios from household incomes to holding costs to median property prices. And then we're benchmarking those ratios to areas like Sydney to showcase this 50% growth upside. And that's how we
Mhm.
kind of paint picture for our clients to understand what locations to invest in. Tariffs are a great discussion point. So tariffs are part of an equation where I look at it, does does this impact our economy slowing down? If our economy slows down, that means unemployment rates will definitely increase over time. So to mitigate the risk for us, our strategies always evolve around not investing in areas that are more unaffordable. So today, for example, I wouldn't be investing in City over the $1.5 million range. I wouldn't be investing in Melbourne over the $1.1 million range because a lot of those indexes show those markets are too unaffordable today. So if there is any risk of the economy slowing down, unemployment rates rising, people losing their jobs, they can't pay off those mortgages, so there's distressed sales now. We don't want to be impacted. So if we're investing in areas that are still growing in terms of government spending, population, economy is growing, more jobs are being created, those people should be earning more. And even if tariffs keep coming on, shouldn't be an impact to the more affordable properties. I hope that
Mhm.
answers your question.
Yeah, no, definitely. And I agree with you. And I think it's important to kind of regress to the median, like as they say, like those upper properties at the 1.5, they're going to be affected the worst in these cuts and above that. And we saw that, especially the eastern suburbs of Sydney when they struggled the most. And we saw the west actually perform a lot better than the east. And like as you said, a great word was, affordability, but not total numbers. It's not like, okay, $500 is
Yeah.
the rental or mortgage that we're accepting, and that's our baseline. No, every area and every market is completely different. Like a place like Perth, probably per capita has more richer postcodes because of the mining and because of the type of jobs that it has, right? But in total figures, you can find properties much cheaper there than you can in Sydney. So it's not exactly like that word for word, as you said. And with the tariffs and unemployment, right? We're actually going through a conference with CBA today, and they were going a bit deeper on the economy side of things and kind of explaining about the tariffs and how much of an impact that CBA are actually preparing for. And really, all eyes are on actually China, not really the US, right?
Mm.
Because our employment is really good right now. As
Yes.
you said, if that changes, then maybe unemployment goes up. But for what it is, it's really, really low, right? That 5% of we're directly impacted by these tariffs to the US. The bigger partner that we have is China. So if US and China go to a trade war and a tariff war, which we still need to pay attention to, China is the one that we're worried about. So we
Yeah.
need to worry about how well they perform and how well they do because of how much we actually export to them. And that can really impact markets as well. So as you said, that 1.5, those are the ones that might be the risky ones, right? And in terms of investors, it's super rare that we would even recommend something like that, right? Obviously, it's case by case.
Mm.
But as you're seeing, that 500 to 550, it is going away,
Oh yeah.
right? And
Yeah.
if you look at the stock market right now, I cannot name the amount of companies that said that they performed really well, really poorly, sorry, and their sales are down, but all their stock prices have gone up. And that's a clear sign that there's just so much money in the market and
Mm.
there's just so much supply in the cash market that even with these rate cuts, it's only going to explode these properties. It's only going to push things even more pressured for people. And
Mm.
there's nothing really changing that's going to make it easier, right? The more and more demand that we have for Australia, which as good of a country it is and as great as the economy is, that's kind of bad because it's going to mean more people want to come here because it is great. So that makes it even more competitive for us in terms of how we strategize and what kind of properties that we are in. So in terms of, leveraging ourselves, it is really critical right now how much we actually leverage ourselves and what properties that we are looking for, making sure that we're looking at it from not a total number perspective, but more of an affordability and lifestyle perspective.
Yeah, 100%. Always go where people want to live and you'll be fine.
Yeah.
And then always keep stacking those fundamentals in your favor for
Yeah.
sure. Yeah.
Yeah, yeah. So just because we saw, a place like Wellington in New South Wales, that place probably tripled in price, right? But you're not seeing people line up to a place like that because, as you said, it's so risky and it's so remote, and it has already had a 200x, performance. Is that even possible to go another 200? It's not really going to happen, right? And then you might say, okay, well, I can't afford a regional city, but then you have to kind of change your perspective of, taking that risk of having that support like us where we can show you where people have been successful outside of Sydney, outside of New South Wales, and in a place that you might not have been there before either, just to get you kind of comfortable around it because there's just so much factors happening outside of Australia that's just going to keep pushing our prices up. We got all those new laws about the first homeowners grant, right? There's no changes to negative gearing. That's anything that's going to happen. If anything, they're probably going to support investors more because rent is starting to climb up pretty high to help with supply. So really, the only thing that the government is going to do is really be focusing on investors because they're the ones that are going to be building these properties up for people to actually rent because we're seeing so many people come from overseas renting, and that's where the real market is going to be right now.
Yeah. And you made a lot of good points that, obviously we both agree that the market will keep moving higher. Your clients coming on board now, are you seeing more investors, more owner occupiers coming on, first-time buyers? What's that mix looking like, and what is their thinking today? Like, I know obviously they want to get into the market, but are they looking at specific areas, price points? Like, what's the investor mindset versus owner occupier mindset today?
I think if you just ask any one of our clients that we haven't really spoke to, they'll just by default say Queensland. And I think that's the one that's just we hear the most attention
From an
of. And it's
investment perspective, or?
from an investment perspective, right? Just because it's easy, right? And everyone will just say the easy stuff like Olympics and things
Yeah.
like that. And there's a lot of infrastructure upgrades, and it is definitely happening, right? But then when people are starting to actually look into it and say, hey, the median is like 800, 900 now in Brisbane, there's other places that are much cheaper that are giving us a lot more rent that might be a little bit lower risk. And me personally, I don't personally like Queensland homes just because of the way their regulation is and how they have to design it. It's not really by choice, it's more of a natural thing. But like that's something that's more of a personal thing, like people want to see something really nice. Like I find clients, they prefer house and land packages just because it looks good, ready to go, don't need to think anything about it. But that's not always the best choice for people as well, right? It really depends on the person. Like we have one client where it worked because they actually wanted to live in there, and that's different. You want to live in there, and they wanted to, rent out where they're living at the moment. That's fine. That makes sense, right? But, strictly investment perspective, waiting 6 months for settlement because it hasn't been built yet, and then waiting for it to actually go through and many things that can go wrong. that might not be most people's preferred choice.
Mhm.
So really what we're seeing the most of now is people are starting to think about Melbourne a lot more seriously in Greater Melbourne and still seeing attention in Perth. A lot of these places that, 2 years ago we're seeing a lot of attention. I'm finding them kind of coming back. I feel like the attention is leaving general Queensland. There is still value there, don't get me wrong, but I think people are considering other places a lot more and a lot more easier too.
Yeah, I love how you mentioned like straight away people are thinking Olympics and like
Yeah,
growth. I think I think about like 70% of clients that we talk to for the first time, that's the mindset. The Olympics are coming in, we want to be part of that growth. And then once we, educate that again, to your point, I 100% agree with you, man. Like I don't think that growth is done by any means, but a few red flags on affordability
yeah,
metrics, few red flags on investor ratios. So we like to invest in areas with at least 70% unoccupied ratios.
yeah,
So at least the market's predominantly people wanting to live there or people living there right now. And it's not the case in Queensland anymore. And that's where I see a kind of risk down the track, maybe the next 2, 3 years, because if a lot of these investors have seen their growth and they want to take some profits, maybe sell, stock comes on market, and do you really get that price you're looking for or think that you have in the property as well? So there's a kind of a way we look
and
at all the markets. Yeah.
to to point that out as well, even the Olympics, right? If it's not as successful as people think and it causes the market to stagnate,
Yeah.
and then people are, overseas people come to Australia and say, "Hey, Adelaide is actually really nice. I want to live there." Coffs Harbour is really nice. I want to live there. And all these other places outside of Queensland start propping up. As you said, you could see investors say, "Okay, well, I've made my money. Let me get out now." And then
Mm.
just go to these other markets, which does happen with a lot of markets where
Yeah.
they come up and down like this, and people make their profit and they just leave. So that is definitely a risk. But I know with the all the stats that you guys go through, a place like Brisbane is still a good investment. Like we're not
100%.
trying to say that you shouldn't be going there at all, but
Yeah.
there is just so much. It's just more deeper than
Many
that than
more
just
things
a
to consider. Yeah.
yeah,
I
yeah,
think with
100%.
the Olympics point, like, I don't think that it can be a disappointment in the sense that Brisbane's already gone through this transformation. So
Yeah,
people think Olympics, all that work is going to be done. But in reality, all the infrastructure upgrades, road upgrades, metro, that's all been done today.
yeah,
So you're
yeah,
seeing the impact. And on top of that, you've seen historically low supply in Brisbane. So that's why you've seen the house prices really escalate. Now
yeah,
we're in the stage, in my opinion, where you're seeing this kind of blow off top in that market, which will last a few years, to be honest, because of the fundamentals for growth here. And a lot of investors are still piling in, especially when people are just looking at price points and comparing a Sydney or a Melbourne to a Brisbane today. And that's
mhm,
when you're seeing the upside come in. And obviously,
yeah,
Olympics is going to be still a big factor because the works aren't fully done just yet, but a lot of it has been priced in or has been completed.
yeah,
But then again, like you want to look at again market cycles, what's the opportunity cost of going to Brisbane or Melbourne today, what the difference is. Those are the things we look at for clients. And that's
mhm,
where there's no right or wrong answer. It's more about what suits you today, what's going to
yeah.
get you towards your goals.
Yeah. Yeah. And if you've already got a place or two in Brisbane, like why would you kind of go again too, right? Like
Yeah,
that always is a factor too,
yeah,
where you've actually invested in and what you are actually looking for. And I think Brisbane as a whole, Greater Brisbane, include Sunshine and Gold Coast in that population is going to obviously boom. And there is definitely improvements to infrastructure. So there's definitely are going to be a lot more people there. Maybe that attracts more big businesses that does actually prop up the city. So we don't really know we don't really know the impacts of the Olympics. I just think there's just too much in the gray for to really say certainty. Let's just keep going there and keep trying to push there because, as you said, like Melbourne is starting to really wake up, and Perth is still got some growth there. And I'm noticing the same thing as you. I never really hear people talk about Darwin too much or Tasmania too much.
well,
Even
that was good
towns.
for performer this year. So
Oh, really? There you
yeah.
go. There you go. Yeah. So, but that's there you go, right? People aren't talking about it, but it's one of the top performers.
But
So,
that's investor led. That's purely an investor led play.
yeah,
And I know for a fact that a lot of these investors are going there with like a 12 to 18 a 12 to 18 month mindset. And
yeah,
that can burn you, especially in property. There's a lot of costs going in and costs going out. So it's
yeah.
not guaranteed profit there.
For me, I think, Sydney, Melbourne, and the whole East Coast and Perth, right? They're going to be much more international. A lot more
Yeah.
international events are happening there. You got,
Correct.
F1, WWE, obviously Olympics, all these other major events. They're all happening here. Even concerts, right? I'm noticing a lot more major stars doing a lot more shows here.
Mhm.
So all these things do matter, and I think all these things are going to make people want to stay and live in these places. So that's why I would still be high on capital cities, as you said.
Yeah.
Somewhere like Brisbane and North Queensland, they don't really get this kind of attention. location,
Yeah.
and there isn't really anything that's attracting people to continue to go there either.
Yeah, yeah, no, 100% agree. Like, yeah, again, just make it as safe as possible for yourself. Put the probabilities in your favor for growth.
Yeah.
And last question, Phil, like from owner occupied perspective, are you seeing clients thinking about leaving Sydney, or if they're staying in Sydney, what kind of price points are we looking at? Because we know today, like, you need household incomes of at least 250 grand to buy in a lot of the, nice areas in Sydney. So how's that from the owner occupied front from your side?
Yeah, honestly, yeah, I am seeing that, and I'm seeing people moving out to either, buying like farms. Like I know one of my uncles bought a farm in Douglas Park or Douglas Hill, is that what it's called?
Yeah.
Southwest in Sydney. Yeah. So I mean, look, that was about 3 hours away. It still cost him about 3 mil. So it's
Yeah.
not really that much cheaper. I find when people are doing as you're saying, it's more lifestyle if it's still within New South Wales.
Yeah.
However, I am seeing people think about, Central Coast and Newcastle a lot more as a permanent place to live. Because if you compare something like, Narellan or any part of these new estates in Western Sydney, which are nice, but they're actually more expensive than Central Coast and Newcastle,
Of course. Yeah.
right? The reason why they're obviously more expensive because like there's a lot of money there, there's a lot of business there. Not everyone can just go to Newcastle and go to Central Coast and things like, or even Wollongong, right? But what I'm seeing is people that can, right? They can are not even selling, but trying to actually buy and trying to rent out what they got at the moment. I think the sentiment with a lot of people is that Sydney's blue chip. Once you get out, you might not be able to come back in. So
Correct.
if you can hold on to it, that's what I'm seeing more people try to do,
Yeah.
right? If not, at least get a similar asset that's within Sydney, because I think there's a fear that, Sydney is becoming more and more unaffordable, and it definitely is.
Yeah.
And so if you are to move out to these places, you might not ever be able to move back.
Yeah, correct. And
Yeah.
because we deal with a lot of investor clients, so saying the same thing as you, City is blue chip. Definitely look at this as an asset class you want in your portfolio. If you have the
Yes.
cash and the ability to still scale, that's always crucial for us. So, our more high net worth investors, they're happily investing in Sydney, and we can still work on building the portfolio. Whereas a more, not, I wouldn't say lower income investor, but someone who hasn't got the same cash flow requirements or the
Yeah.
same borrowing capacity, what's going to happen is you're going to put all your eggs in one basket and you can't scale that portfolio easily after your purchase in Sydney. So it always depends on what's happening. But long term, we've got a lot of clients still looking to secure a property in Sydney, whether it's to live in or they want that in their portfolio. And I think that will always be the case. So Sydney will always be an unaffordable market. It's always been trading at around, 6 to 8 times median wages. Now it's more around 60 next to your median wage in Australia. So it's pretty crazy how unaffordable it is today. But then again, so much wealth, and we keep harping on this point, so much wealth has been accumulated in Sydney already from people who've
Yeah.
been in the market for 10, 20 years. And because its property prices have doubled, even tripled in some locations, so much equity is there for them to use. So Sydney's going to be a location where you've got these same buyers, these same owners controlling this market for a long period of time. It's going to be passed down generations, in my opinion.
I think cash is the key word that you used, right? In Sydney, it's not really income or serviceability. I think in Sydney, where people are finding the most value is that development side, right?
Yeah, 100%.
Because as you said, right, if you've got the cash, Sydney is the place to be,
Yeah.
right, in terms of investment.
Yeah.
But, we're not going to recommend a first-time investor to buy a $2 million home,
No, no,
right?
no.
But if you've got 500K cash and you can find something for 1 million and you can put money into it,
Yeah.
I think we would probably tell you to do that first before you would do it something interstate.
There's a lot of money in the development side. So you mentioned yourself, the entire area has been rezoned from, North Sydney down to western suburbs. Everything's been rezoned to at least R4 property zoning, which means you can build multi-level high-rise assets. So that means a lot of money can be made even just buying a property with the right zoning or a zoning change coming in, even putting a DA approval on that, you'll make a few $100,000. To your point, just buying the right blue chip location within Sydney itself, areas above $1.52 million, doing a renovation, you're making hundreds of thousands of dollars again in that. But cash flow is crucial. So very different type of investment, very different type of goal and client requirement there. But there's always money
Yeah.
to be made everywhere. That's the key as
And
well.
and and the common thing that I'm seeing as well, right, with that new rezoning is I'm finding some people are trying to buy the houses around them so they can negotiate with developers,
Yeah,
right?
yeah.
So we've had one of our clients, their neighbor actually came to them and said, I've got three sons. They all make six figures. We as a family want to buy your home because we want to buy your neighbor's house as well. And then we're going to negotiate with the developers and we're going to do this. And if they don't give us the offer that we want, we might do it ourselves, right? And there'll be plenty of banks that'll be willing to give you that money because Sydney is so blue chip and because Sydney is seen as so safe that the bank will risk that higher cash for you to actually develop it because the rent is there. The rent is definitely there. You will find someone to rent it, right? And even in the most sketchy suburbs of Sydney, right? It's very safe, very nice, very clean. Rent, and you're not paying under 600 a week rent, 650 a week
100%.
rent for
It
a
comes back
three-bedroom
to
house
housing.
anywhere in Sydney.
It comes back to there's a shortage of homes, and because there's no supply, even though the cost of building apartments has gone up 70%, people can still see an opportunity to develop, make the money, and pay a lot more than market value today to secure the sites. So that's
Yep.
tells you all
Yep.
about where we're at from a supply
Yep.
perspective as well.
Yeah, yeah. And all ready to go too. Like a lot of these developers that are thinking about all these rezonings, right? A lot of them are ready to go and have already started to kind of accumulate and start to build that because the approvals are there. As the government is saying that approvals are going to be smooth and easy. I guess we'll have to wait to see how serious that really is. But if that is true, then a lot of these, then that's where you can really make a lot of money for some people. And holding on to that asset makes it even more valuable just to see if you can develop it.
Yeah, yeah, it's going to be an insane market, man. Like next 2, 3 to 5 years, I think we're going to see some insane movements in price. I think to our previous discussions, there's going to be a widening in that wealth gap between
100%.
the top 1 to 5% and the middle class. That
Yeah.
will slowly be evaporated,
Yeah.
unfortunately.
Yeah. And with this new development rezoning, I think that can actually make it worse, right?
Yeah, yeah,
Because you're going to have more renters that are trapped in the rental cycle in
yes.
these areas that can't afford a house where that is because there's just that houses don't exist there. There's no more houses there. They're all apartments. So, in terms of even if the supply increases, it might only increase for apartments. It might not increase for new estates and houses. So
That's what I'm
housing will
saying.
become more competitive.
Yeah, 100%. That's why, like, just purely with my investment capital, and like, we always secure house for land value. We don't like
Yes.
to buy the apartment class. I think in some areas we'll outperform 100%, but we want to be ensuring the client will get that long-term growth because houses are like rare, like shiny assets that
Finite.
won't be available in the future. And then I
Yeah.
think that's the best part about it. If you can foresee what's coming, then you'll be fine.
Yeah. Yeah. And that's the thing, foreseeing it, right? And
Yeah.
planning.
Or trying to.
That's,
We're not
yeah,
fortunate.
trying, trying.
Yeah. It's been awesome chat again, Phil, and we'll
Great
talk
catching up with you,
soon.
man.
And all the best. I know it's been very crazy busy, so yeah,
Yeah.
wishing you all the best soon. See you,
Wish you the
man.
best, man. Good catching up. See you soon.
100%.
Thanks, man.